my title for tonight is The Good, the Bad, the Ugly, and the Pot of Gold at the End of the Rainbow. First, just take a look at a snapshot of the overall economy and financial markets right now. If you've been to our events before, or if you've seen our updates online, we look at these Rockdale charts regularly. They come out monthly, and Rockdale, you won't be able to see all these names. I'll point out the significant ones to you. And what they do is once a month, they update their outlook on 20 different areas of the economy. They look at fiscal policy, monetary supply, consumer sentiment, real estate, interest rates, etc. And if you were here 6 months or so ago, well, not here, but at our economic update about 6 months ago, you might recall that, and if you don't, I'll tell you, all of those were green except for the three in the bottom right. All right? Today, not surprisingly, I mean, you guys, you're not financial planners maybe some of you are, but you're not surprised that economic conditions aren't quite as good today as they were about 6 months ago. So now we only have two green, unfortunately. The labor market and consumer spending. Right now is a good time to be an employee, right? If you are looking for a job, there are more jobs than there are people who want those jobs. And we'll talk some more about some of the employment picture later. And consumers, individuals, are still thriving. We still have money to spend, and we've got money in the bank. Our debt is actually near all-time lows, so we are spending money. But unfortunately, there's a good bit of red up there. The yield curve, which I'm going to touch on later, did invert. If you're familiar with that term, I'm going to talk about what that means and what it signifies. The housing and mortgage market has changed drastically. And again, if you've been in these events, you've heard me for a couple of years, I've been saying that I'm concerned that that is eventually going to be the cause of the next downturn. And here we are. We have rising interest rates. We have significant inflation. And the cost of housing is significantly higher than it was a few years ago. So we'll touch on that as well. The ones on the bottom right have been there for a while. Geopolitical risk has been red for as long as I can remember, right? There's just uncertainty with Ukraine and Russia, China, et cetera, et cetera, et cetera. So that's just a starting point to give you an overall picture of where we're at today versus 6 months ago. That's the good, the bad, and the ugly to start. This chart shows us the S&P 500 going back about 25 years. And what I think is interesting here, just as an overall picture, is that you tend to see these inflection points in the stock market where we tend to be on a good ride. And the correlation here that I want you to see in this slide is PE ratios. PE ratio, and you'll see these at the tops and the bottoms, it shows the PE ratio. That is the price earnings ratio. It's what the price of the stock is versus their earnings. And when that number is high, it means stocks are generally overvalued. The price is high relative to the money they're making. When PE ratios are low, that means it's undervalued or maybe fairly valued. Well, what's interesting is the market tends to go on these runs, and when it spikes here, the PE ratio of 25 back in 1999, 2000, next thing you know, significant drop in the market. Market goes down because prices come down, PE ratio drops down to a low point, comes back up. You can see the picture up, down, up, down. So the punchline is today, where PE ratios, when the market was at its high, were at 21. Right now, we're at about 16, 15 or 16. So that's a mixed bag of news, right? Why are the PE ratios lower than they were 6 months ago? Anybody? Because the stock market dropped, right? Market's down about 20%, give or take, depending on which index. So that brought PE ratios down. That's not so good. But now PE ratio is at a good spot where I can't promise you the next thing is an uptick, but traditionally that's an inflection point that we're at an impetus that could cause a rise next. So again, we'll talk some more about that. A lot of the questions we're getting, and if you watch our weekly market video updates, if you don't get those, if you're not getting our regular weekly update, we send it out through email, we send it on LinkedIn. If you don't get those, please let somebody on the team know. I don't want to say they're great because I'd be biased, but I do think they're useful. We try to get as much content as we can in a minute. Sometimes it goes to a minute and a half, 2 minutes. Our goal is a minute. And one of the questions that we just keep getting a lot of recently, of course, is are we in a recession? That's the big question. It's all over the news. It's all over conversations around coffee and at the mailbox. And just so you know, so from our perspective, The answer isn't going to surprise you, is we don't know. And the reality is there's a committee that determines if we're in a recession, and there's a bunch of factors they look at. The common discussion is around whether the GDP dropped for 2 quarters in a row. That's the sign that normally triggers a recession, but it's not the only thing. The committee gets together, they look at all the economic factors and make a determination. Well, guess what? They don't make that determination until 3 to 6 months after it's already happened. They say, oh, we were in a recession 3 to 6 months ago. So if anybody says that they can tell you we're in a recession or not, they're lying. You can't possibly know. Even if you're on that committee, you probably can't know because you're still just one vote. But this is a company that we respect a lot named ClearBridge. They've done research over the years looking at different criteria in the economy and how that points to a recession or an expansion. And what you'll see is in May and June, the bottom line overall signal was we're in an expansion. It was green. Again, not surprisingly, just this month, a couple weeks ago, at the end of July, it triggered to orange or caution. So that doesn't mean we're in a recession. It means the chances of a recession increased somewhat. Did it go from 10% to 50%? I can't tell you the exact figure, but the chance of a recession is higher now than it was just a month and 2 and 3 and 6 months ago. The big changes here, commodity prices dropped, retail sales dropped, and the yield curve. Again, I'm going to touch on that later. Yield curve is a very common indicator for a recession. So that changed drastically. I will tell you also that even though this is a great signal, historically, it's not definitive proof that we're heading into a recession or in one. So ClearBridge, at least twice historically, they've been in the orange and saw the cautionary risk and didn't go into a recession. So I'm not telling you we're in one. I'm not telling you we're heading into one. I'm telling you the chance of a recession is substantially higher now than it was just 1, 2, 3 months ago. All right, so let's talk about some good stuff. I'm pretty excited about this structure. I'm going to start good, give you bad and ugly, and then start with a pot of gold, end with a pot of gold. I think that's kind of a good sandwich. So some good notes. This is S&P earnings or corporate earnings. And we were kind of on this roller coaster ride for 2013 to 20 or so. Of course, we had a big drop. Everybody knows why in 2020. I don't even want to say it anymore, right? So significant drop right away in earnings, but a quick recovery and a steep recovery. Now, a lot of that was government stimulus and intervention, right? They plugged $7 trillion or so into the system. What else is going to happen when they print a bunch of money? It's going to stimulate the economy. And who said inflation? I should give you a prize. You can give the rest of the presentation for me. Inflation. Back then, we said it. I don't remember if we said it in this room or some other venue, but we said inflation's coming. It was pretty obvious when you add $7 trillion to the system, it's going to inflate savings and housing prices, et cetera. So we inflated our way up here. Now, it's leveled out recently, but that's not bad. Obviously, you'd like it to keep going up, but S&P earnings are still positive. Corporate earnings, the institutions in general are doing well. They're making money, they're profitable, and the economic data is good. So what does that mean? If they're in good shape, it means the labor market is in good shape. I mentioned it's a good time to be an employee. I've had people come into my office. There's 2 conversations that I sort of like to have. If somebody says, I'm thinking about selling my house, I'm like, go home, call the realtor, and put it on the market an hour ago, because I don't know how long this is going to last, but it's not going to last forever. So get it sold. If you're a realtor in the room, there's usually a few. You probably agree with me. The other is, I'm thinking about looking for a job. I'm not totally happy with my current job. I've been there a long time, and I feel like I'm underpaid for what I'm doing. Whatever it might be, I'm like, go home, get a recruiter or get 5 recruiters, get your resume ready, and get a job. Because it's a great time to find a job, but that's not going to last forever. It's going to change. And best guess, I think all these data points are going to change in a not too distant future. I think housing is going to change. I think the labor market's going to shift. So that's why I tell people, go do it quick if you're thinking about it. I really disrupted a client a few weeks ago. He was like, Darrin, my wife and I put a contract on a house in Alabama. They're beginning construction. It's going to be ready in a year. So we're going to sell our house in a year here in Alpharetta. We're doing some work on it to upgrade it and get the value up. I was like, no, I'm stopping this meeting right now. You're going home, you're meeting with the realtor, and you don't need to do any renovations, just get your house on the market, because otherwise you may get stuck with 2 houses in a year, and that's the worst case scenario. So those are the 2 conversations. So not only is unemployment relatively low, we can have conversations about how they measure it. Is it real? Is it biased? But the reality is employment's in good shape, no matter how we measure it, no matter how we discuss it. And finally, wage growth is there, earnings growth is there. So for a long time, going all the way back to 2008, when the market declined and the labor market was struggling, for a long time we had jobs come back, but we didn't see wage growth for a very, very, very long time. People were they were happy to have jobs and to get paid. People were happy if they got a 401k back, because for a while those were just closed out. So finally we see wage growth, which is a positive sign. Okay, so if corporate America is doing well, and therefore individuals are doing well, that means that our balance sheets look good also. This shows a trend on our personal assets, total, not yours individually, but the total U.S. assets, so everything we own from homes and cars to bank accounts to investments. Hopefully the investments are a big part of that green line, the assets, the bar. On the bottom, so that's the green line is the assets. The bottom red bar is our liabilities. What is our mortgage, our credit card debt? And interestingly, that's pretty flat, right? The liabilities haven't changed much, but our assets and our income have gone up substantially. So what does that mean? Our net worth, our assets minus our liabilities, has climbed steadily for a while, a little bump in the road again from 2020, then a steep, rapid incline to get back on track. Again, a little bit of flattening out recently, but I'm not ready to call that a bad sign. We're still in good shape as Americans. So now I got to cover the bad. Let me get my water. I've mentioned a couple of times, this one's mine, right? I've mentioned a couple of times that I'm going to talk about yield curve inversion. So first of all, what is yield curve inversion? If you're going to lend somebody money, if you're going to lend the government money, you would expect to get paid more if you lend it to them for 10 years versus if you lend it to them for 2 years, right? If I go to you and say, hey man, can I borrow like $10,000? I'll give it back to you in 10 years. You're gonna want more interest than if I say I'll give it back to you in 2 years or 2 months, right? Logical. And that's the way the market, that's the way bonds and yields traditionally work. And on the flip side, if you go to the bank and you lend them money effectively, when you put money in a bank in a CD, you're lending them money. If you put it in a 5-year CD, they're going to pay you more than if you put it in a 2-month CD, right? Okay, so that's normal. What happens occasionally is that short-term yields sometimes end up being higher than long-term yields. The 2-year Treasury sometimes pays more than a 10-year Treasury. Doesn't happen often. It happened in 1989. So this is zero. This is the long-term and the short-term are exactly the same rate. Normally we're above it. But 1989, 2000, 2008, and at the end of 2019, it barely kind of touched the line. What do you think the gray shaded area is on this graph? Who said recession? A few people? I don't see a hand. Somebody said it. It wasn't the voice in my head. Bob said it. I'm not surprised. So the reality is, in every circumstance here, when we dip below zero, when the yield curve inverted, a recession comes right after. In a lot of ways, I want to say that it's 100% accurate, because historically, it happens every time. Nothing's 100% though, right? I want to start a petition that says weathermen should only use 5 to 95%. There is no 100%, right? You walk outside, 100% chance of rain and it's dry and sunny. You walk outside, 0% chance of rain with no umbrella, you're soaking wet. So not 100%, but traditionally it does mean a recession follows. And of course, as you can see, this is in the bad section. We did dip below just recently. And interestingly right now, you get a higher yield on a short term than a long term. It does, again, mean it's a higher chance that we're heading toward a recession. Now, here's something interesting. I would think that the common belief is that if we're in a recession, it means the stock market goes down. Is that probably what nobody wants to nod or shake their head, nobody wants to be wrong. But I would think if I didn't study economics and finance and do this for a living, I would assume they're hand in hand. Not necessarily. The market actually is almost uncorrelated to the economy in a recession somehow. The market can go up, down, or sideways in a recession, but there is pain from a recession. Right now where it's great to be looking for a job, everybody wants you and will compete to pay you as much as possible. In a recession, jobs contract. Housing market contracts. Borrowing money contracts. Corporate America doesn't have as much access to capital, so corporate America contracts. In fact, somebody in the room who I won't name, although it's probably not a big deal if I did, just recently, they didn't lose their job, but for the first time in years, I was at lunch with this person, I'm not making eye contact, I heard them say they laid off some people. That's the first time I've heard of layoffs. Very, very early, most companies are still hiring, but if you're looking, if you have any indication of your future for change, make sure you're planning for it in case these things come to reality. Okay, these graphs might be a little painful. It's a good time for me to remind you that we started off with your thoughts about gratitude, and we're going to finish off with a pot of gold. Okay, so take a deep breath with me. We're gonna ride this out. Somebody tell me, somebody in this room will, what you think that upper left and upper right charts are. I will tell you, it's the stock market. What do you think the left and right, you don't have to get each one right. If you have really good vision, you could probably see it at the top. But what do you think the top two charts are showing us in the stock market? 2008 versus what?
2022.
Close. I'm going to give you half credit. You could have half a blanket. You got ahead of me. I do have scissors somewhere. Not here, though. I can never find them in my house. Our daughter likes to craft, and I can never find scissors at the house either. So the upper right is 2008. You're correct there. The one on the left is 2000, 2001 stock market. Okay. Do y'all think this is like total participation? You don't have to raise your hand, just some kind of like little head nod or something. Do you think they look somewhat similar? Yeah, you actually all, a lot of yeses, like official head nods and yeses. That was a really good job. All right, so 2000 and 2008 look fairly similar in that market dropped. Both of these, you can't see the numbers, but about 20, 25%. And then they recovered about half of that. A little bit steeper than that, but went down about 20, 25, came back up half of that. Same thing here. Okay, Travis, what do you think the bottom one is? 2022. You can have the other half of the blanket. All right, so audience participation again. Do you think the bottom one looks a little bit like the top two? Yep, right? Market dropped about 20%, recovered about half of that. All right, that wasn't painful yet, right? This is just like looking back. We already know that happened. Take a deep breath. So this is what happened next in 2000 and 2008. I should probably stop smiling for a minute. Okay, so in those two periods, after the steep decline and semi-recovery, the next stage was about a 40 to 50% drop. Am I saying that's going to happen? No. Am I saying there's a chance it's going to happen? Certainly, yes. I actually, at the end of the presentation, will tell you I laid out like 5 to 10 stages what I thought would happen in the economy years ago, and we've been through the first 5. I've got my thoughts about the next 3 stages, and I'll give you that in my kind of toward the pot of gold, all right? But I don't want you to be scared. I want you to be aware is what I want you to be, right? Everybody's better off if they're aware, if they have clarity of what's going on and what could happen, right? I would say that the main thing is that you pay attention, that you're aware, and you have a plan, right? If we manage your money, we have a plan. If you manage your money, nothing wrong with that. I would just say, I've noticed that the average investor, whether they invest it themselves or they have an advisor, don't really look at their statements until about every 3 to 6 months. Now, that's kind of nice for us. It means you're not calling us every day. You're not looking at a statement every day. But especially if you're managing money yourself, if you got a 401k plan at work or just some side account or whatever you're doing, I would just say now more than ever you should pay attention, because if things flip, historically when this happens, people look at their statements 3 months later and they're like, oh man, I didn't realize the market, I heard like there was bad news, but I didn't realize the market went down 50%. So pay attention, call, even if we don't manage your money, give us a call, ask us. We keep a score for the market. We can let you know how we're looking at it. So a little bit ominous, and that wasn't even the ugly part. So ugly is inflation. Again, totally predictable. A year, 2 years ago, we didn't gather here. We filmed this from my basement. Armin and I got together in my basement. We filmed it. We sent out pizzas to some of you that signed up so you could eat pizza instead of Ruth's Chris while we presented. And we said, inflation's coming. They're printing money, and there's just no avoiding it. Plus, here's the other thing. I've been saying this for probably 5 to 8 years, is that the Fed has been extremely late in raising interest rates. 8 years ago or so. So 2008 happens, market crashes, they drop rates, they go to near zero for years. They needed to do that to stimulate the economy and soften the blow. But eventually, around 2015 maybe, plus minus, Armin nods, so it must mean I got it right. Around then, the economy was in good shape. Job market was good, employment was good, housing, et cetera. That's when they're supposed to start raising rates to get ahead of inflation. And we said then, we got up over every 6 months, we would get up and say to you all, the Fed's messing this up. They're waiting and they're waiting. And because of that, when inflation comes, it's going to be more drastic and more painful. So here we are. It was inevitable. And of course, we didn't know and they didn't know that COVID was going to happen to end up exacerbating it by putting more money in the system after that. But ultimately, now we're at 8%, 9% inflation. It's unstoppable right now. I will say this, that while it's painful right now, number one, unfortunately, it's a lot more painful to the lower income earners, right? I actually pulled out one slide to make sure I didn't stand up here all night, but I did have one slide that broke income earners into 5 deciles. And for the lowest income earners, the average percentage of their income they're spending on just gas and food alone is like 67% of their income, just on those 2 things alone. So very painful for that segment, but all segments had a drastic increase in that area. Now, the only little bit of decent news that comes out of that is because it is so drastic now, the Fed is getting extremely drastic to fight it, right? Instead of raising rates a little bit, instead of cutting back on their budget a little bit, they are making drastic changes. So with those drastic changes, there actually is more of a chance now of them getting inflation back in check. The latest forecasts for inflation over the next 10 years are in the 3.5% range. I wouldn't trust those entirely because I think those come from, they ask a bunch of people and they average it all out. And when you get an average, it's always going to be just mediocre. But there is a better chance of them getting this in check now because it did happen so drastically. Still, Fed messed up. I think Armin told me recently you can always count on the Fed to mess things up. At the same time, our other favorite saying is don't fight the Fed. Meaning, if they're giving away money easily, the market's going to go up. If they're contracting, the market is going to struggle. The economy is going to struggle a little bit. So still don't want to fight it in either direction. Okay, I mentioned I was going to talk about housing, and I talked about for years that this is inevitable. It's going to come. Eventually, interest rates are going to go up. Now, what I didn't know and what we didn't talk about is how much house prices or values would go up. We were always talking about eventually interest rates can't stay at 2-3%. We said they're going to go. Historic averages were 6% or so, 7% historic average. So we said, rates have to go up to 4, 5, 6, maybe 7, 8. Who knows? What we didn't know that on top of that was that house prices were going to increase by 40 or 50%, right? Now, a year ago, house prices were rising by about 5 or 10%, pretty above average. Normal average is about 3%. And a year ago, when we did this, I said, I think the housing market will flatten out. I think it'll slow down. I don't think there'll be any major pain, but it has to slow down because we can't keep up 10%. Well, here we are a year later, and the housing market is up 40, 50%. I mean, it's absurd. I don't know how accurate Zillow is, but if you go on Zillow, you're going to be tempted to sell your house. I guess the big question that always comes up is where are you going to go? What are you going to buy? But I don't know. I might just go live in a mud hut in Tanzania for a little while. So it is ridiculous. And as you might be able to see here, it's a little bit fuzzy and I'm sure you can't see it in the back, but I will tell you that this year, the cost of a home mortgage is up 46%. Wow. Because of the combination of the rising interest rate and the home values. I mean, that's a huge difference, right? And yeah, we've had wage growth of 6-7%, but wage growth of 6-7% doesn't align with the cost of home ownership going up 50%. And I mean, the reality is a lot of you probably know somebody in the room, a young person getting started, first job, maybe they're recently married, maybe they have 2 incomes, and they can't afford to buy a house. I mean, It's a blessing. I mean, I know your story. I won't give the details, but they were blessed. Cody that works for us, I mean, they were blessed to get a house. I think there was like 50 people for every house, and you couldn't get one. And if you want to hear the story from them, they've got a great story. But a lot of people are on the other side of that, and they make good money. They're in good shape. They make good economic decisions and literally can't buy a house. It's just not an option. So I do think that the consequence of this is that instead of the market just slowing down a little bit, it's going to be a little bit more painful. Now, what does pain look like? There's probably 2 or 3 different arguments or cases that I hear out there. What I've seen historically is that it's not even so much about where home values go. To me, it's that the market freezes. All of a sudden, there's just no activity. Like in 2008, when now that was a credit crisis, a mortgage crisis, and a bigger economic impact, but when the real estate market flipped, in theory, values were down 10 to 30, 40%, but nobody was selling their house. Nobody was selling, nobody was buying, nobody could get a mortgage. So there was no activity. It just went to zero activity. So it's hard to say how much the values will go down, but I do think there'll be a massive slowdown. Right now, there's still low inventory and there's still a lot of demand. And as we started, earnings are still in good shape. People still have money. So right now, it's still driving it up, but it's not sustainable. And I think we all know that. The other thing that's working against us, we all like to pick on China. The general category is supply chain. We have these general global supply chain issues, and now China had some recent issues that even compounded it further. They had a spike in COVID cases. Fortunately, there's the spike. Fortunately, it came right back down, but with that came a drop in productivity and economic activity in China, where we get most of our microchips and technology. So therefore, it exacerbated our supply chain issues. Has anybody tried to buy a car in the last 3-6 months? You can raise your hand too. You can't win a prize, but you can raise, sorry. It's not gonna listen, but you can raise your hand too. I mean, if you're trying to buy a used car, it's almost impossible. They're just not out there. Prices are up, but it's one of these things again, it doesn't matter what the price is, it's just, you can't even find one. I went with my mother-in-law to look for a new car for her. This was probably about 3-4 months ago. And we would go to car lots and there'd be 3 cars on the lot. It was just empty. We're like, yeah, we want to come test drive such and such car. They're like, yeah, well, we can order you one. It'll be here in 6 months, but we can't really test drive it. I don't think that'll work. I mean, we went to, there was a Ford dealership, had 3 on the lot. A Subaru dealership had 0 on the lot. We went to a Honda dealership, which was the best of the bunch. And he's like, we have 1 of each car. If you want this one, you could have this one. And so that was really, all that's caused by the supply chain issues, which have been exacerbated in China. All right, pot of gold, right? We want to end on a good note, right? With dessert. How perfect is that? Except for Dean. Dean doesn't eat dessert, and he's on the camera anyway. So the pot of gold is this. This is my blow my mind slide. All right, I'm gonna take it away for a second. This is the slide I was telling you about, Rich, that I'm teeing it up so now it'll be hard to blow your mind. But I got all these slides from different places, pulled it all together, and I will tell you, this slide shocked me to the point that I actually wanted to send it to other people to make sure I wasn't missing something. And I'll leave the door open. I didn't have time to send it to anybody. If you see something different than I do, go ahead and correct me. What this shows is midterm election years. What year are we in? Thank you, you're still awake. Got it. All right, the gray on the bottom is the last, I think, 15 midterm years. What's the common denominator, or the S&P return, each of those 15 or so years? They're all negative. 100% of them are negative. The best case scenario was -7. The worst is -38. The average was a negative return of 19% in every single midterm election year. That blew my mind. Okay, but what's the other side of that? This on the top is the year after the midterm election year. What's the common denominator there? Not just up a little bit, right? On average, 32% a year, spike of 58. The worst year was up 9% the following year. I couldn't believe that 100% of midterm years were negative and 100% of the year after were significantly positive. Blew my mind, still blows my mind. So like a lot of the data that I'm showing you today, none of this is foolproof, right? In fact, I think a lot of what I've shown you is almost contradictory. I've shown you some slides that indicate we're almost definitely going into a recession and almost definitely the market's going down. And I've showed you other slides to say we're almost definitely going to have a good period, right? So they can't all be right, but each of these kind of gains more and more clarity for us, more understanding, and more hope in a lot of cases. Because I think while we've experienced some pain, and there probably will be some more pain in the future, I think ultimately we're going to end up with some good news and some pot of gold at the end of the rainbow. A little bit more to piggyback that. Did everybody get that? Does it blow your mind like it blew mine? Except for Armin, he already knew this. I saw Rich take a picture, so I guess it blew your mind too, right? You're going to use that somehow in a commercial. So consumer confidence and the stock market. This is one of those data points that is really interesting, very intriguing, very telling, but like all the others, even though it historically is 100% predictive, things can't stay at 100%. So what we see here is this is the University of Michigan Consumer Confidence, 50-year history. They constantly go out to a group of people and they say, how do you feel about the market and the economy right now? What's your confidence level? And they come up with a score from 40 to 120. The average, I can't even see that, 85? 85.6 is the average, okay? What's crazy though is that when consumer confidence is high, there's 8 peaks. Guess what happens to the stock market when everybody's exuberant and feels great about the market and economy? Market doesn't do well right after those the 8 most exuberant periods. Now, when I say not do well, yeah, the market drops to a degree, but it does average about 4 to 5% in the following 12 months, okay? So well below historic market averages, just when everybody's most excited and exuberant about the market. On the flip side, 1975, 78, 79, 90, all these periods where everybody's doom and gloom. The world's coming to an end, market's going to crash, we're going back into a Great Depression. The lowest of the low, the next 12 months, the S&P on average goes up 25%. So what does that mean? I'll answer it instead of putting you on the spot. It means we're clueless. I mean, we have a clue. It means the average consumer is clueless, right? When we're positive, the market's negative. When we're negative, the market's positive. When we pull out of the market, it goes up. When we go in the market, and by we, I try not to say we. I mean, we mess up. We're not getting it all right. But the reality is these indicators are sort of like contra-indicators. They don't make sense, right? When we feel good, we do bad. We feel bad, we do good. There were several others, right? The inflection point when the market's going down and PE ratios drop, that's when the market goes up, vice versa. So all these contrary data points. I mentioned to you that I've had this sort of long-term forecast that I've been building all the way back to 2008, 2009. And I just want to kind of piggyback, going back in history and then what's happened since. So back in 2008, 7, 8, the market crashes. I like to share this story. I guess it makes me feel good about myself. I feel guilty that I feel that way. But I remember being in a room with like 200 advisors. A company named Genworth gathered all these advisors. And the guy in the front, his name was Alexei Rodopoulos. He said, who here thinks that the stock market's going to go up? This is early 2009, like March 2009. And literally, I was the only person that raised my hand. It was so literal to the point that he laughed at me. He thought I was joking. He thought I was being like the prankster in the room, raising my hand like I'm just going to be different than everybody else. They all looked at me like I was nuts. And that time I got lucky and I was right. The market started to go up. And my reasoning was the market had dropped enough and the economy, sometimes the economy needs a reset button. And that reset button happened then. So it was time and it was primed for the market to go back up. We had this recovery. The thing I liked also is back then the government was making some bad choices and building debt, but corporations and individuals were cutting our debt and cutting our spending, and really they were laying people off, which was painful, but it was the right approach because it allowed the economy to recover. After that, corporations started building lots and lots of cash. They were hoarding it. The reason was they cut expenses, they laid off people, they matched the economy, but there was no place for them to initially invest it to make money, so they just hoarded cash for a while. Now, I said then that eventually they'll find opportunities to invest in research and development for the future, and that's what happened. But what happens with research and development? It doesn't pay off right away, right? When you design the first electric car, or when TiVo designs TiVo, I remember thinking TiVo was like, I read it on an airplane, this thing called TiVo, you could pause live TV. I'm like, I gotta buy TiVo stock, that's the best thing ever. Well, it took like 10 years to take, and TiVo practically went out of business before it made sense, but it was the best technology ever. Now we all use it like, I mean, we couldn't imagine not pausing live TV. So research and development takes a while to pay off though, right? It doesn't immediately come out into stock profits and earnings. But eventually, everyone was rewarded by this because corporate profitability went up. All these stages and decisions they made along the way, 2016, 19, the market's raging, everybody's happy. What we didn't know was we thought there'd be just a normal pullback because of the cycle, but next came a black swan event. Black swan event is an event that you can't predict, you can't see it coming. So 9/11 was a black swan, COVID was a black swan. So it comes, shuts down the economy. You know, the other thing about that was, I mean, there's been 14 black swans like that in history, pandemics in history, and 13 of them came and went pretty quickly and the market went right back up. But this time was different because the government shut down the economy. The global government shut down the entire global economy. So that shut things down. However, as we've talked about and how it affected inflation, the Fed quickly poured $6, $7, $8 trillion into the system. The economy came right back up even though people were staying at home. And finally, now we're at that point that we've been talking about for a few years, unfortunately, where we have the impact of rising rates and inflation that were inevitable because the Fed didn't raise rates when they should have and because of the extra money that's in the system. So I promised you that I would tell you my opinion. Everybody, my other staff doesn't necessarily agree with me. They don't necessarily disagree either. And I don't speak for the Fed or Wall Street. But in my opinion, now that we've had the run-up to 2020, the downturn, then this recovery, and then recent burst from the inflation and interest rates that we saw coming, I think that it's likely that the next three stages will be somewhat of a recovery. I think those lower PE ratios, the low consumer confidence, all those indicators that tend to point to some recovery, I think that will bear fruit over the next 3 to 6 months. However, there's still some pain in the, sort of like right now, I'm thinking of a volcano, right? I don't know how volcanoes work. If there's a science teacher in the room, please correct me. I don't even have the right words, but I picture the lava like in the volcano down there stirring a pot, but it hasn't overflowed yet. So right now, I think we've got some grace period, but I do think that lava is going to spew out and we're going to feel some more pain. I don't know if it's going to be the 40 or 50% that we saw earlier, but I do think that after some recovery, we do have another drop to come. Because my reasoning is inflation and interest rates that we've talked about haven't really bared out yet to cause a lot of pain. It's just started. And we haven't seen it affect corporations yet. We haven't seen it affect consumer spending yet and consumer savings yet. We haven't seen it affect housing yet. And I do think we will see those pain points, unfortunately. I have to end on a good note, which is I think after that, we will see maybe the best bull market that we've ever seen. If not, I think somewhat reminiscent to the late 90s. If you invested or around in the 90s, the market just went up and up and up. The joke back then was you could be a monkey and throw a dart at a dart. Well, you couldn't be a monkey, but a monkey could throw a dart at a dartboard and pick any investment and make a ton of money in the late 90s because the market was just that good. My reasoning isn't just because I want to end on a positive punchline, I promise. My reason is back to the research and development in 2013 and 15 that we said doesn't pay off immediately, but it eventually does. I think in the next 2, 3 to 5, and in 10 years and beyond, our world, the United States in particular, is going to look entirely different. And some of you probably have stories from your own personal lives or work environments. I think technology, innovation, education, healthcare, transportation will look entirely different in a very, very positive way. Some of this came from that regular research and development. Some of it sped up because of COVID, right? All of a sudden, companies like Zoom and other forms of technology had to advance. We see, telehealth in medicine now where you can call somebody, they can help you. I think that's going to advance a lot further. So I think with all of that, we're going to see major, major innovation and technological revolution that's going to cause an extremely thriving economy. But we might have a little pain before we get there. And like I said, my main thing is I just want you to be aware, I want you to pay attention and be prepared, and ultimately be there for the pot of gold at the end. So glad y'all came. I hope y'all enjoyed it.